Your money is held at the banks, and the banks are hanging on by a thread. I'm going to tell you exactly why that is today. You might have your FDIC insurance, but let me tell you, I got to explain what's going on at the banks. Underlying all of this system, we can see that there is obviously turbulence, and I'm going to break down exactly why that is the case. You're not going to find this information elsewhere because we are getting into the depths of it, and quite frankly, only a few understand it. We are just going to scratch the surface, and already that is much more complicated than what the average person is going to bring to you. So I want to give you that so that you are empowered. If you find this video informative, simply hit that thumbs up so that you can get the latest and greatest information. First things first, stock traders get back to believing that everything is just perfect. I read through this article, and the main point is, quite frankly, that it will take some time before rising interest rates become problematic. They think it's a few quarters out. I'm about to show you what's happening under here, but I just want to explain the fact that according to the stock market, everything is a-okay. And you could see this on various measures of liquidity and where we are at right now. The Federal Reserve is doing what they call quantitative tightening. So they are selling off treasuries and mortgage-backed securities, and they are at a point from $9 trillion. They're coming down every month, but it's taking time. During this process, that can all be balanced out, and there are other factors, of course, as part of the money mirror method that we'll talk about in today's video that kind of balance that out. So you can create liquidity through different means, but the quantitative easing or quantitative tightening, whichever is being done right now, quantitative tightening, is like the overall number one most important factor. So everybody on the mentorship group already knows about this. They hear me talking about it every time. But for this right here, I'm going to give you some other details. So here we have it. You could look at several charts I'll show you today. Number one being the reserve balances with the Federal Reserve banks. And that is in a very clear, there's a chasm that has formed in between the reserves and the stock market itself. And so you could see over the years, like these two, they move together, and then suddenly they are completely erratic over the last few months. So what does this mean? Well, the banks are basically holding excess reserves at the Federal Reserve. Why are they doing this? We'll talk about this more in a second, but this has happened. Usually they're moving together in lockstep, but occasionally they do fall apart from each other and then revert back to the mean. They haven't done that recently. There are several factors of this, and we'll discuss that momentarily. I just want you to know that that's happening. First, part of that would be here, the money market funds. More and more money is flowing into money market funds right now. Why? You're getting 5% on your money, and it's liquid. You could pull that out whenever you need. You're getting a return. It is, they would consider this to be very safe. So that there's a lot of money. But that money is not just from people inside of the US. Here we have it on the retail side and the institutional, both applying more capital to money market funds. All right, and you can compare that to deposits as well. So deposits, just in the the recent past, we have seen deposits come up a bit, but in general, you could see the definite trend. There's a big difference, and that people are willing to put their money into money markets rather than to put more cash into their deposits. Okay, because you're going to get a better return. So why are you going to put it in the bank, right? This is just showing us what the Federal Reserve has been doing. They've been selling off. This is their balance sheet declining. At the same time, the banks are utilizing this temporary facility of the Federal Reserve. They're doing this at a rate they haven't done before. Now, I know this stuff might be complicated, and some people are probably wondering, like, what the heck is this guy talking about? Let me break this down, make it very easy. I promise. You stay to the end of this video, you're going to get it all, and you will know more than most people out there, because this is really going to show us what's going on. Okay, the bank crisis is not complete. You saw that in March 2023, where all these banks started to fail. Credit Suisse, one of the most important global systemically important bank, was collapsing, and they had to come in. They merged between UBS and Credit Suisse, and the government of Switzerland had to hide this in secret, not for what was known to be, the standard of 30 years. They extended that to 50 years. They are keeping what happened under lock and key for an unprecedented 50 years. There's something in this bank crisis that smells real fishy. Real fishy. That's one point, okay? Here we have it. The quantitative tightening is ongoing, and that is draining liquidity from the system. Other factors have made up for it. More money is flowing into the United States. So right now, at this time, we are seeing a record level of investment into U.S. equities as well as bonds. So US is really winning as a result of this, and that could explain a lot of why the market is just pumping itself right now. And banks are using the Fed's temporary facility at a record level. This is not normal. Let me be very clear. Okay, they're using it at a record level when that's a high interest rate, when that's not the preferred method. So keep that in mind. This is just showing us BlackRock. Okay, they have these real estate investment trusts. Oh, it's so wonderful. But they have paused redemptions. I think this is, my memory escapes me, the 11th month in a row, 10th or 11th month in a row where they have paused redemptions. What does that mean? So you invest in this fund and they say it's liquid. You can pull it out whenever you want. And then you say, okay, sounds good. Oh, there's a problem? Yeah, we're going to pause redemptions. You cannot pull out your money. Excuse me? I thought you said it was liquid. Oh, yeah, well, we can change the rules at any time. How does that sound? What does that tell you about the strength of this industry right now? If they could take their money out, half of it would probably go to the exits. What does that tell you about the banks? What does that tell you about this particular sector and the strength of some of these companies? I've seen this myself where the redemptions are a huge problem for these funds because something went real bad and they just say, we're going to pause redemptions right here and now. And people get very upset, let me tell you. Okay, so let's break this all down. I'm going to make this easy, okay? This is the most important thing right now. The most important thing. And if we understand this, we're going to have a better grasp as to what is going on. And then at the end of this video, I'm going to show you what you personally have to do. So stay tuned, okay? Check it out. The main purpose of QT, quantitative tightening, is to drain reserves and reduce the lending capacity of the banks. You're intentionally trying to slow things down. Let's get inflation down, everybody. Let's slow that down by doing quantitative tightening. So we are not going to, buy all these asset-backed garbage. We're not going to buy the treasuries and so on. Let's reduce that down. And therefore, it's going to reduce the lending capacity of the banks. And there we can have slowly but surely things come down. If we do it at the right rate, we're going to manage the soft landing, as they say. All right. Now we have a near record high at this time on many levels, actually. But the reserves at this point are at a near record. And anybody in the mentorship group knows what I'm talking about. The reserves are pretty much, they've been here for well over a year. And at this level, we can see that, this is something that it's been up and down sort of, but it's been sustained roughly around these levels here. And that matches generally over time, the reserves match with the stock market. However, in the last couple months, it's just been out of whack where the stock market's going up, but those reserves have basically been flat. And that's kind of an odd circumstance. What is interesting and why you should know about this is that the reserve requirements of the banks are set to 0% right now. 0. They don't have to keep reserves. So technically, all of these reserves are excess reserves on top of which the banks can multiply credit. So there's the reserve requirements. Let's just say they had to keep 10% in there. Fractional reserve banking, right? Let's say, okay, you're going to keep 10%. Oh, we have a crisis now. Okay, let's bring that to zero. So now all of that, so from the 10%, bring it all the way down to zero, all of that is excess reserves. And so they can use that to create more credit, to stimulate more, to add more liquidity. So yeah, they're draining liquidity through the quantitative tightening. It's a show. It's going on in front of everybody. Oh, we're doing that. Oh, but the reserves, still today, we're being told there's no crisis. But clearly there is, because the banks, they're operating in like freak out zone, and that's what's going on today. I hope you get me on that, okay? Big stuff. This may explain why lending is relatively strong despite the rate hikes. So rates are still pretty high. I mean, historically anyway, when you look at this, they should be higher, but anyway, based on inflation. But let's take what we can get. This is important because we have to start to address, like, why is the system acting like this? Why is the financial system like this? Well, this is one of the reasons. I hope you get me. If you want more clarification, post it in the comments below. I will make more videos. I will do more stuff. Mentorship group, of course, gets all the latest and greatest. You got to know about what's happening with the debt situation. Oh my goodness. Just look at it. Credit card delinquencies are on the upswing. Most people didn't know about that. Of course, it's still at reasonably low levels. At least that's what they'll tell you. But I wanted to suggest something else to you, which I thought was really important. And that is the average credit card annual percentage, or APR, hit a new record of 20.63%. You imagine, now you got to think to yourself, well, some people, they didn't pay their bills and this and that. Oh yeah, I get that. What about that? What about this? Check it out. More consumers, 47%, are carrying credit card debt from month to month. Excuse me. Are you kidding me? Of those carrying balances, 60% have also been rolling them over for longer than a year in today's rate environment, compared with 50%. So more people are utilizing this debt than ever before. So you think about that. 20% interest rate, all right? They've got, on average, the last time I saw the numbers were around $6,000. So you're carrying that for over a year. For all of these people, half of the people that have credit card debt are doing this. $6,000, 20%, you do the math, this is crushing people. You add on top of that the student debt, the banks have a problem. The banks have a very clear problem, and we could experience, if rates stay where they are, we could experience much more delinquency over the next little while. We're going to have to see. I will track that. If you're subscribed, obviously you're going to get the latest and greatest. Typically during these timeframes, during a recession, people are scared, people are concerned, and gold is one of those safe havens for a lot of investors. This is paper gold, of course, but it's gold, as the term would suggest. Of course, physical gold always in high demand. That's a whole different story, but we can argue about that a different day. This is just basically talking about, let me quickly mention China. They are doing a lot of stimulus right now on every different level, and they realize that their economy is slowing down and they have a very big debt problem. Their banks are hurting big time. And so they can stimulate, and that would temporarily help them out, but they need more longer term reform that would change things. And, investors don't really believe it at this time. So that's one factor as well. Okay, I want to let you know that you don't have to just say, oh, okay, what am I going to do? I'm going to just go in my bunker, I'm going to go hide? Absolutely not. I want to tell you what you've got to do. These are just some tips at the end of each video. I like to do this. I like to give you a few tips if I can, and that's why we're doing it right here for everybody who stays until the end of the video, okay? Don't keep too much money in cash at the banks. You got to make sure, number one, too much cash is not a good idea, but also banks at the same time are generally just not the place to keep that. You've got to hold, as I say right here, you got to hold real assets. So number one, you want to have your money in a place where they're being held over a period of time. You got to have businesses. You got to have your assets in real estate, in precious metals, in things that are real, tangible, stuff that you can touch. That's important stuff, okay? And there are a lot of different other examples. I'm just noting those. And so that, I think, is where we start to look at the depths of this and try to make sense of it all. Because, yeah, the banks are having a problem. They're not going to go away. The banks are not just going to disappear tomorrow. Look at Credit Suisse. It gets bought up. The average person probably won't lose money because the insurance will cover them. But you got to understand what that means is, hey, if you're going to be locked out of your money for even a weekend, what if it's a week? What if it's a month? What are they going to do to the currency itself? They're going to devalue it. This is why we can't hold cash. But that's the warning indication that we should be all experiencing right now. Get that in your head. US is still in the strongest position, but make sure that you know what countries they're exposed to when you're investing in companies. Think about this. You might say, oh, I'm invested in a US company, but you've got Coca-Cola, for example. Coca-Cola is in all different countries around the world. Maybe for whatever reason, Coca-Cola is like super popular in China, and the China market represents 50% of Coca-Cola sales. You wouldn't really know that. You think it's a US company, but you've got to understand that if you're going to expose yourself to these different stocks, to these different companies, or maybe you're a business transacting with a particular company, you need to know what their exposure is. So always keep that in mind. It doesn't matter which stock exchange they're being traded on. It doesn't matter if they're incorporated or head office is in a particular country. No, we've got to look at it at a deeper level. Okay, I want you to get the most important stuff, the biggest information that I can give you is always going to be at the Discord. So you can get that at the link in the description. I'm going to give you the latest and greatest, including the video of the day. You'll be notified inside of Discord for the video of the day. Check it out. Click on that link in the description. And of course, the comment of the day. Everybody's favorite new part of the episode. Here it is. Norse Falconer says, by the way, thank you for the comment. And here I thought GAAP stood for Generally Accepted Accounting Practices or Principles. Apparently, it actually means government adjusted financial propaganda. That's right. That's the way it goes. They're able to manipulate the numbers. That's why we've got to know both the manipulated numbers and the real ones and bring it all together so that we have the truth. I'll see you on the next one. Take care.